All right, let's jump right into this explainer and zoom straight into step 7 of our banking analysis checklist. Today, we're uncovering a bank's true profitability. If you've been following along with the sequential framework, you already know that analyzing a bank means looking at the spread engine, the asset quality, and the operating efficiency. But eventually, all of those moving parts have to translate into actual, bottom-line returns. So we're going to demystify two of the absolutely most critical acronyms in finance, ROA and ROE.
So, the big question we need to tackle from the source material today is this. After all the complex financial maneuvering, is the bank actually making real money? I mean, a bank can boast about its rapid loan growth, it can show off incredibly low operating costs, and it can even point to a seemingly pristine headline asset quality number. But all of that is really just clever machinery. The question this step forces us to ask is whether that machinery is actually generating a worthwhile return for the very real risks being taken.
And this brilliantly illustrates our focus. It anchors us straight to the source document where we decode exactly how to read return on assets and return on equity together. As the checklist lays out, this is the exact moment the professional reads the results to make sure they aren't being fooled by a flattering headline. We're going to treat this analysis like an X-ray, looking way past the surface to see the structural, financial bones of the institution.
First up, the clean scorecard, return on assets, or ROA.
Think of ROA as the core engine of the bank. It's the unfiltered truth about a bank's efficiency, completely stripping away the illusion of borrowed money. It is the cleanest single scorecard out there. Why? Because it's leverage neutral. A bank literally cannot artificially pump up this number simply by taking on massive amounts of debt or ballooning the sheer size of its balance sheet. It tells you exactly how much profit the bank is squeezing out of every single dollar or rupee of assets it holds. It's just a raw, undeniable measure of management's ability to allocate capital effectively.
When we look at Indian banks specifically, our source provides a really clear baseline rule of thumb. An ROA above 1% is considered good. Now, in isolation, 1% might sound remarkably small compared to tech or retail industries, right? But remember the context of banking. Banks operate on incredibly thin margins across massive asset bases. So hitting that 1% threshold means the core lending engine, the asset quality, and the cost structure are all aligned well enough to produce a solid, baseline level of healthy profitability.
But let's take it to the next level. An ROA pushing above 1.5%, that is the absolute gold standard for excellent performance. If you see an Indian bank consistently hitting or exceeding this 1.5% mark, you are looking at a highly optimized machine. It tells us the bank has likely secured very cheap funding, maintains a wide net interest margin, keeps its bad loans incredibly low, and runs a very lean operation. It's the ultimate hallmark of a premium banking franchise.
Now let's flip over to the leverage reality, return on equity, or ROE.
If ROA is the engine, ROE is the turbocharger, and it usually grabs all the headlines. Unlike ROA, return on equity naturally runs way higher. This is because banks are fundamentally built on leverage. They take a small slice of their own equity and pile a mountain of borrowed money, like deposits and wholesale funding, on top of it to make loans. This borrowed money turbocharges the returns for the actual equity shareholders. But, as we'll see in just a second, that turbocharger can be incredibly dangerous if the underlying engine is actually weak.
Which brings us to the crucial check, synthesizing ROA and ROE.
Because here's the thing, looking at either of these metrics in isolation is a total trap. We have to overlay them. This starkly contrasts a genuinely strong bank against a fragile one. If you see a high return on equity, you must immediately ask how it was achieved. If it's built on a foundation of a healthy return on assets, say that 1.5% we talked about earlier, well, that's genuine, high-quality profitability. But if a bank shows a high ROE and their underlying ROA is paper thin, they're simply using massive amounts of leverage to artificially pump up the returns for shareholders. This is a very fragile setup, and it's a common pitfall we see frequently in public sector banks. It works fine when times are good, but the absolute moment asset quality slips, that heavy leverage will crush the bank's capital.
So, to actually run this diagnostic check yourself, there are exactly 3 metrics you need to pull from the financial statements. And don't just look at them as isolated numbers on a page. Pull the ROA to understand the core engine's true efficiency. Pull the ROE to see what the shareholders are actually getting, and then crucially, calculate that leverage relationship between them. The difference between the two tells you exactly how much heavy lifting borrowed money is doing to generate those final profits.
Let's put this into practice with the Ask Yourself framework. It's time to put on your financial detective hat and actively interrogate the data using these specific sequential steps. You want to ensure the performance isn't just a temporary fluke of the economic cycle. First, ask yourself if that clean ROA is above 1% sustainably. And I mean as a consistent run rate, not just for one lucky quarter where they sold off some treasury assets. Second, apply that genuine versus fragile test we just learned to the ROA. And third, look at the overall trajectory. Are these returns improving or declining over the cycle? Because a bank slowly expanding its ROA from 0.8% to 1.1% over a couple of years is telling you a very compelling, exciting story of compounding operational improvement.
After running this whole engine and turbocharger comparison, we arrive at the ultimate deliverable for this step, proving real profitability.
And it all culminates in this really powerful thought from the source material. This step is literally the quantitative confirmation of whether margin, asset quality, and efficiency are all compounding into real profitability. That's what this entire process is about. If the bank has a great net interest margin, clean asset quality, and lean operating efficiency, it absolutely must mathematically show up right here as a high ROA and a genuinely strong ROE. If those previous metrics look amazing but the returns here are poor, something is leaking. So as you dive into your next banking analysis, ask yourself, are you being blinded by a highly leveraged return on equity, or have you actually verified the clean, undeniable truth of their return on assets?